So, sort of as we move towards the end of this wonderful podcast, I think the industry, if we go back to the pensions industry, they've heard quite a lot about the why of why they should invest. And I think they're keen to, for those that, and I'm not going to go into the whys and wherefores of whether we should or shouldn't invest in venture capital, that's best left for another forum. But people are becoming increasingly interested in the how. How do we actually do this? Because there's one thing to talk about the why, it's another thing to talk about the how. How are you seeing things develop? Is it just about people developing LTAFs? Is it about people developing internal expertise on venture capital or developing relationships with venture capitalists? Are we seeing different ways of operating for different pools of pension money or institutional money, whether it's a master trust or maybe a contracted out scheme or the LGPS or an insurer even? How are you seeing that develop from your perspective?
Yeah, I think it's developing in lots of different ways for lots of different investors. Some of it is because the nature of the capital requires a certain approach. And some of it is because the nature of the institution means they're just in a different place in terms of their journey. So there are and have been pension funds who've participated in venture and private markets before, and for them this is really an extension of potentially what they were doing before or complementary to it. There are some organizations for which venture perhaps doesn't make any sense at all because of the profile of their liabilities and so on. So to your point, it feels like that thinking's been done and there's been a good sense of where does this make sense, and we're turning now to how. And the how is really at the foothills of the journey. I mean, LTAFs, I think, seem to be shaping up as a big part of the solution, but they're 2.5 if that years old and very young, and how do they work? And there's not too many of them around, certainly focused on venture specifically, but more are being approved. I keep a kind of track of the list of LTAFs, but that seems to be a vehicle that has some momentum. In terms of whether it makes sense for people to do this themselves or partner or whatever, again, I think those things are not necessarily mutually exclusive. Again, with us, it's taken us nearly 20 years to get here. We did a mixture of both in the beginning. We invested in funds, we did some fund of funds, and then more recently we became a direct investor. So I'm sure various organizations will go on their journey, but the most important thing we did was get started, and I think that's the question: is what's the right way to get started and kind of build exposure over time, and people are working through currently exactly the right way for them in the context of where their money comes from and what is and isn't allowed, and the maturity profiles of it as well.
If we're after that long, interesting debate about the future of workplace DC and at retirement solutions, let's return to sort of the legacy issue of buyout and surplus. And I know this is something you and I have talked about a lot, but how is that debate evolving? It seems to kind of move quite swiftly, which is quite phenomenal given the slow pace of the pensions industry. Where are we with that debate? How are things evolving? Are more CFOs, you run around the country talking to them, you said, are more CFOs open to the idea of run on? Is DB trauma fading?
Yeah, I've been surprised by the level of engagement by CFOs in the run-on discussion and debate, and by that I mean willingness to consider run-on. Because to your question, the legacy pain of DB, that I've had the last decade of actuaries turning up every 3 years telling me I've got to put more money in as the CFO, that's going to resonate. But I think for a number of reasons, CFOs are open to the question. One is, I think they do understand that the surpluses of today are built on a very different foundation to the surpluses of yesterday. So one of the challenges, I guess, the pain of DB of the past was, for years in the 90s, you told me we were in surplus and we had all these holidays. Then we swung to a decade of deficit, so we're going to have a few years of surplus and another decade of deficit. The surpluses of the 90s, early 2000s were built on, kind of an expectation of 8, 10, maybe even 12% equity returns that were baked into the numbers. The surpluses of today are built on an investment strategy that expects a return that's lower than the insurance company is going to operate if you do a buyout. You know, the average pension scheme investment strategy today is lower risk than an insurance investment strategy on buyout. So it's just a very different place that we're at. I think, you know, CFOs also acknowledge that actually a lot of the capital that's going to back a buyout deal, if a buyout deal is within the premium. So there is a question of, well, should they retain that capital and run the scheme themselves? Now, many, and it may well be many, and may rightly be many, will still conclude, you know what, off balance sheet is the right thing, buyout is the right thing, that's where I'm at. And, you know, I've got several clients in that, very much in that camp. But I think there are a number that are much more open-minded to run on, given what I just said, and as I alluded to earlier, the potential to use some of that surplus today and it's generated in the future to solve, you know, what they might view as pain coming down the road in DC if they don't take some action now.
So if we turn once back to investment, do you think this like third pot, does that open up greater investment diversity within the world of DB? Because let's be frank, it's become quite boring recently. I would argue possibly even more boring than the world of insurance. Sorry, insurers. But we have this very heavy emphasis on LDI and gilts, and then we have this very heavy emphasis on global credit, which is used in a similar way to an insurance company to provide the cash to pay the benefits. And post LDI crisis, there's been no further investment in private assets because everything else got sold, and you got this wonky portfolio with too much actually allocated to private assets. Are we seeing things like settle down, and with the surplus, is that opening up greater investment diversity in these portfolios?
Yeah, I think so. And I think we have to sort of change the mindset of trustees, where we've been on a de-risking journey for a long time and we've come out of a lot of these assets. And that's been the right thing to do. It's not that we've done the wrong thing, but we now come to a point where assets are going back up. And the assets that we've got securing members' benefits are much safer. They're much more hedged. They're much more de-risked. With much more certainty around that. So these additional surplus assets, there is the ability and opportunity to do something a bit more exciting with them and not just invest in LDI and sort of credit, which is what a lot of the schemes now see. I think there also has to be a shift in the mindset of if we invest surplus assets in more return and income generating type riskier assets, then as funding levels improve, as surpluses grow, the proportion invested in these risky assets will grow as a proportion of the overall scheme. And therefore, this idea of re-risking has got to be something that trustees and companies become comfortable with going forward after their long de-risking journeys, that it will be a period of re-risking. But you're not re-risking and taking away the certainty that you've already built up. You're re-risking on these kind of additional surplus assets. And I think how you invest them will potentially depend on how you are going to use or distribute that surplus. So if you need flexibility in that surplus where you want to pay it out regularly, you might invest in the more liquid sides of those risky assets. Whereas if you're trying to grow it over a longer term with a longer time horizon in place, then that opens up the more illiquid assets like private lending and real estate debt, etc. So I think that's where you'll start to see a mix in what those surplus assets might look like, depending on each individual scheme's objectives for surplus and surplus distribution.
Taking us back to LTAFs, bringing that idea back in again, because as you mentioned, you could have an LTAF that covered every single asset class, but as you just outlined, it might be that you want different asset classes at different points of the member's journey. So is your feeling that, you know, that pension providers like you should be going out into the market and looking for the best individual LTAF in each asset class, or is there a place for a multi-asset LTAF as well? Because the question is, can you find a manager who can manage all those quite specialist different private asset classes equally well?
I think that's an excellent point you're making there, Charlotte. And from my perspective, I think we should adopt the same approach we've adopted with public markets, which is where you can, where your scale allows you to do so, to go to directly to individual asset classes and providers and be very selective there. So I think that's I think perhaps one of the privilege of size and scale that allows you to do that. And in my view, that would be my preferred option when it comes to LTAFs or direct investment. But I do also have to take into account when I talk to other trustee colleagues who are managing, pension funds of different sizes and different scales, then having the option to come into something that has already been pre-designed, pre-thought. Although I have a preference for LTAFs that have multiple asset managers underlying them, because I do think that way offers you the opportunity to make sure that they've selected well-performing managers coming into that. I think that's important. But I think that will definitely can deliver for smaller pension funds. I'm perhaps less of a fan of multiple very specialist, very, as you said, specific asset classes being managed by one group. I think maybe that's something I can be. Maybe it's an a priori, but one that for now I think is what I think more reasonable.
Yeah. So you would prefer to select an individual manager for each asset class, even if you decided that the best thing for your pension scheme was to use the LTAF structure. I mean, it does. Go on. Sorry.
So I was going to say, I think there are LTAF structures out there that are more open, have a more open architecture. And I think perhaps that would be the first place I would personally look. But it doesn't mean that others would be, that it wouldn't be an option. It's just that perhaps I have a slight bias to that.
If you have this surplus, given that you still have to lock in those LDI levels, what are the implications from investment? We are the professional investment podcast after all. So how is it going to change how you invest? What is it going to open up? What's going to be a possibility and what isn't? If we can talk about the things that pension schemes are doing, even the potential asset classes that they might now be looking at that they wouldn't have looked at in the past.
I mean, I think what it means is we will be investing very similarly to insurers, but we don't have the same investment restrictions, which means that we have a broader investment universe, which I think we will leverage. So we should leverage the areas that insurers don't have access to. But I think in trying to answer your question, I think that what I think makes a lot of sense for pension schemes, mature pension schemes and run on is that most will have negative cash flows. So it becomes really critical to figure out how do you try to match your outgoing cash flows with your incoming cash flows. Mm-hmm. And in that, you will think about, do I need to fix my outgoing cash flows via longevity swaps, etc.? Do I believe in that or not? But understanding your outgoing cash flows becomes really important, which is actually also a member data thing. Do you have proper member data so you can assess your liabilities in a careful way? And if you don't, everything else is more tricky. Then I would say that you would build up this cash flow matching portfolio, which would be a lot of credit, secure income, those types of assets, where you can look at your incoming cash flows and where you have natural liquidity in your portfolio coming from those investments. And then you need to think about in inflation, especially, and a bit of rates exposure and reinvestment risk. But I think it becomes, and I think it's interesting actually. Sorry if I may go back to your low dependency basis. I don't think the regulator is fully ready to consider these cash flow matching portfolios because they work very differently than traditional equity bond portfolios. Because here, what really matters there is if you have a big credit portfolio and you want to keep your bonds till maturity, you don't really care about the market price. You care about the default rate. And that becomes a much different, and that actually gives you a lot of stability that you can kind of look through the immediate market swings as long as the default rates are you have enough prudence in your default rates, and hopefully have managers who are picking good bonds. But that becomes quite a fundamental shift.
So do tell me, is there anything in particular that stood out to you about this story about the pensions bill? And there sure was a lot stuffed into it.
Well, there are lots of different pieces to it. That's right. Bits about merging small pots in DC, bits about surplus release in DB, but I think you talked about that with Morton quite recently. Bits about defined benefit super funds, about creating scale in DC. But hidden away in there, there was something about the government taking reserve powers to mandate investment potentially for pension schemes. And clearly what they have in mind there is that if they don't get enough traction on people investing in the UK, then they may take powers to make that happen. So I'm sitting here in Border to Coast office, one of the local government pension scheme pools. And so that made us sit up and take notice a bit, I guess.
That seemed to play equally badly with everybody in the pensions industry, I have to say. Nobody really wants mandation.
Well, I suppose there are some good things about it. If you're a trustee, then if you're worrying about your fiduciary duty and whether you can reconcile that with playing nicely with government investing in the UK, then it gets you off the hook, I suppose. So I can see that it makes sense in that respect. I suppose the concern for us would be that, we're doing a lot of this anyway, frankly. The LGPS probably invests about a quarter of its assets in the UK, and a fair amount of that is in private assets. But we only want to invest with people and alongside people who want to do it, and in projects that actually are going to generate a decent return. So I suppose there's a bit of a worry that if everyone floods into a too small supply of projects, then it will just bid up the price and destroy the potential return. So I think government needs to think about that a bit when it brings the bill through.
There is an awful lot of money in the pensions industry, and if all of that is chasing the same sort of venture capital or local growth, we could be in a situation where it no longer becomes worthwhile to invest because you're just buying it at the wrong price, which of course is at the heart of investment. But
well, we need we need a good supply of projects, don't we? That's something else we might talk about a bit. It's not unique. I was in Canada a few months ago talking to some of their pension funds, and they were having exactly the same conversations with their government. But they were saying to government, well, where are the toll roads and the airports for us to invest in? You've got to make them available to us. And that's true in the UK as well. It's
impossible for the financial sector to do it all, for asset managers to do it all. We're not going to be able to make all of the positive change that's needed to manage the climate crisis without policymakers also helping out. So that in a way might feel like if you say, well, I can't do it, it's got to come from governments, it's got to come from policymakers, maybe I shouldn't bother to do anything at all, could be one conclusion from that. But if you look at it another way, you can think, well, I can't do it all, policymakers need to help out. That's my opportunity to start influencing policymakers. So we've talked about stewardship, and you've alluded to this, but can we talk a bit more about, it's called systemic stewardship sometimes, about actually using your stewardship ability to engage with governments and to affect their decisions. And I think you're in a rather unique position in Railpen, because obviously all of your members are in the UK. You, like many other pension schemes, you're a heavy owner of gilts. And obviously, because you're Railpen, you have that connection directly sort of to the state. Can you talk about how you think about that systemic stewardship process and what change you think that Railpen can bring about in terms of policy change?
Yes, so I'm agreeing with you vociferously here. So yes, absolutely, we need policy and regulator action. And yes, we as investors, as asset owners, as other participants in the investment chain have huge agency in that. So point one, we could directly as Railpen go and engage with regulators in the UK and elsewhere. And we do that. And that could be through responses to consultations, calls for evidence, proactive meetings and so forth. So that's absolutely something we can do. We can also do it through our membership engagements and membership organisations, and trade bodies. So think like PLSA, UK Civ, PRI and others. And that can be a really powerful way to convene and kind of leverage a broader base of investors to communicate more strongly through that. So absolutely, we've got agency in that, and absolutely we should be doing that, and we are. But I think there's lots of other things that we can do. And if you think about taking that to your other leverage points and your other intervention points, then that's fills, a load more possibilities around policy engagement. So we were talking about investee companies that we're engaged in. And so we can talk to them about their policy engagement and advocacy, both the stuff that they do directly and through their trade associations. That's hugely important. We know how much time and energy and money companies are spending on policy engagement and advocacy on climate, on nature, and other topics. So how are they doing that? Is it science-backed? Is it evidence-based? Is it in line with their stated strategies and goals? When they say we want to get here and there's a big policy dependency, are they working hard to rectify and address that policy dependency, or just leaving it hanging on the side there? So we can do that. We can do it with the people that we work with on a consultancy basis, on third-party researchers, on events, anything like that. Wherever we've got a touch point and an influence point, we can use that to raise a topic as critically important as policy advocacy. So we try really hard to do that. And hopefully we live that through to its fullest, but that's something that we pay a lot of attention to and try and do further. And again, I mentioned our credit is through external managers. And so again, we've got that influence point there with the asset management community. And actually Net Zero Asset Owners Alliance wrote a really good paper around that a while ago in terms of setting up and aligning expectations with asset owners, asset managers. That dynamic's really important. So
you raised, sorry.
Yeah, sorry. Number one, definitely do an awful lot. I'm really passionate about this, so I've got a couple more points if I can cheeky get them in. So number two is, what are your trump cards in that conversation? So as an asset owner, what are the particular endowments that I have that give me credibility and legitimacy at that policy table? Well, actually, I'm really well lined up, alignment of interests with most governments and policymakers and regulators, because I care about long-term economic prosperity. I care about financial stability, as do those governments and policymakers. Our success as an organisation hinges on that. And so we should turn up to those tables and be really well aligned and be able to then put in our views and our expertise as a day-to-day implementer, an asset owner, an investor in, say, the UK and economy and elsewhere, that brings that together. And that's something that a lot of other people can't genuinely do if they're representing a single issue, a single industry, and so forth. So that's the second one. The third one I should just say is, look at the groups that have done policy engagement and advocacy so well for decades, really, really effectively, poured lots of time and money and effort into it proactively. What can we learn from them? And the fact that they recognize it with the importance that it deserves, that it's almost existential to them as their organizations. And so therefore they accord it this level of resourcing and strength and money. And if you think about our purpose as an organization, which is to secure our members' futures, lots of other asset owners, put simply, climate, nature loss, inequality, those systemic risks threaten our ability as an organization to deliver on our purpose. So this work is so important to do, and therefore you need to put it up on that level, put up the resourcing, put up the expertise, put up the time in order to be able to try and do it. So that's my hobby horse fully rolled out of the stable and galloping off. I just think it's so critical to do.
Okay, well, let's talk about maybe how you think about those different types of private market assets. And I think they fall into four groups. You've mentioned some of them already. We've mentioned real estate and infrastructure. Then obviously you've got private debt and private equity, which could also be infrastructure and real estate, just to make things complicated. Yep. But when you're thinking about the member journey, and as we're at a really interesting inflection point now where DC is really beginning to come of age, if we can say that, and people are really starting to think about not just the wealth gathering part of the journey, not just building up the pots, but how we provide a retirement income. How do you think about those different assets? What role do they play at different points along that member journey, even maybe into retirement? Can you talk to us a bit about that?
Yeah, absolutely. Yeah, so you're absolutely right to point out that private markets is not one single homogeneous thing. And I think that's really, really important, because each of those different asset classes has a different risk return profile. And even within those asset classes, there are different opportunities that have different risk return profiles. So it's about understanding that and understanding where that fits into the member's journey as to how you can make the most of them, essentially. So for someone further from retirement, focusing on growth is much more important. Asset classes like private equity, venture capital can really provide members with strong levels of growth, but you have to be really careful with some of these because they are very high risk or can be very high risk and also relatively expensive. So it's important to consider how they're used and how much they're used within portfolios. So we actually use these alongside other infrastructure and real estate opportunities to diversify the portfolio, lower the cost, lower the risk for members. But some of these infrastructure and real estate opportunities are also more higher growth in the spectrum of that element. So the core plus type of area. So it's a little bit more in terms of generating returns. And that, again, is something that you can access for someone much further from retirement and give them the ability to deliver those returns longer term. And then as you get closer to retirement, we've got to think about the fact that it won't be very long before someone is retiring and still investing for maybe 20 or 30 years. In fact, people are today, actually, as they draw down. So they're going to be accessing their pot through an income, regular income, over that period of time and drawing down. And so there is that still long-term time horizon, but their objectives in retirement are slightly different. There is an element of protection against market falls, so being able to provide members with access to stability of investment returns. But they still actually want some growth because their pot's got to last them 20 years, that they're still got to have their income. So there's an equal or maybe greater focus on that growth element as well. So here, more stable types of investments, maybe largely real assets, infrastructure, real estate, you mentioned earlier, can play an important part, particularly if they have income associated with them, which is strong and linked to inflation. And that long-term inflation-linked income can actually make a big impact on people in retirement. In fact, that's probably what we're all wishing for in retirement anyway. So these assets naturally lend themselves very well to that point of the spectrum. So it is about thinking about that point and that journey as an individual goes through that and linking the asset class to the specific requirement of that person at that point as we move through.